In December 2024, the Reserve Bank of Australia held interest rates steady at 4.35% for the 8th consecutive meeting. Most media outlets framed this as a pause in the cycle, a holding pattern. But buried in the minutes was a paragraph that caught my attention. The board expressed concern about household debt servicing ratios reaching levels not seen since 2008. Yet property prices in Sydney and Melbourne rose by 3% in that same quarter. Something doesn't add up. If you own property in Australia, this matters to your net worth directly. If you're relying on superannuation for retirement, the funds backing your pension are heavily exposed to residential and commercial real estate. If you have children hoping to buy their first home, the mathematics of home ownership are moving further out of reach each year. And if you're watching Australia's position in the global economy, this question cuts to the heart of our long-term stability. Are we sitting on a genuine wealth engine, or a structural vulnerability disguised as prosperity? In this video, we'll examine three things. First, how Australia's housing market became one of the most expensive in the world, and why it didn't collapse when others did. Second, what the data reveals about debt, supply, and foreign capital flows that most people overlook. And finally, what this means for Australia's economic resilience heading into 2026 and beyond. Let's begin. To understand today's situation, we need to briefly go back to the late 1990s. In 1999, Australia made a decision that would reshape the housing market for decades. The government introduced a 50% capital gains tax discount for investment properties held longer than 12 months. This wasn't framed as controversial at the time. It was sold as an incentive to encourage long-term investment. But it had a second-order effect. It turned housing into Australia's most tax-efficient wealth accumulation vehicle. Not shares. Not business investment. Residential property. At the same time, negative gearing rules remained in place. Investors could offset rental losses against their taxable income. This combination created a powerful financial incentive structure that favored property over almost everything else. Now add a third element. From 2001 onward, China's demand for Australian resources began accelerating. Iron ore, coal, liquefied natural gas. The terms of trade improved dramatically. National income surged. Where did that wealth flow? A significant portion went into housing. By 2008, Australia had developed one of the highest household debt-to-income ratios in the developed world. Then the global financial crisis hit. Most Western housing markets collapsed. The United States, Ireland, Spain, all saw devastating corrections. Australia did not. Why? Because Australia's banking regulator had maintained stricter lending standards than the United States. Subprime lending never took hold here in the same way. And China's stimulus program kept demand for Australian exports strong, which insulated employment and incomes. So the narrative formed: Australian housing is different. It's safer. It's backed by sound fundamentals. That belief has persisted for 16 years. But let me show you what that belief has created. I want you to look closely at this ratio. The median house price in Sydney is now 14 times the median household income. In Melbourne, it's 12 times. For context, a ratio above 5 is considered severely unaffordable by international standards. Anything above 8 is typically unsustainable without extraordinary circumstances. Australia sits at the extreme end of this spectrum. Only Hong Kong and a handful of other global cities are more expensive relative to incomes. Now here's the part most headlines miss. Household debt as a percentage of disposable income in Australia is now roughly 210%. That means the average household owes more than twice their annual income. This is not inherently catastrophic. Debt can be managed if incomes are stable and interest rates remain low. But the vulnerability lies in sensitivity. Australian households are now extraordinarily exposed to interest rate movements. A 1% increase in rates translates to a roughly 15% increase in monthly mortgage repayments for variable rate borrowers. That's a tightrope. Let's talk about supply. Australia has chronically underbuilt housing relative to population growth for the past 15 years. Migration has averaged between 200,000 and 300,000 people per year since 2010. But housing completions have consistently lagged behind household formation. Zoning restrictions, approval delays, and construction costs have kept supply constrained. In economic terms, we've created a supply-demand imbalance that structurally supports high prices. Now add foreign capital. Between 2012 and 2017, Chinese investment in Australian residential property surged. At its peak, foreign buyers accounted for roughly 15% of new dwelling purchases in Melbourne and Sydney. That flow has slowed since regulatory changes in 2017. But the effect on price discovery was significant. It lifted the ceiling on what was considered normal. Here's what concerns me. Australia's banking system is heavily concentrated. For banks control roughly 80% of the mortgage market. Their balance sheets are dominated by residential lending. If property prices were to fall significantly, the entire financial system would be exposed. Not just homeowners. Superannuation funds. Pension assets. Retail investment portfolios. This is systemic concentration. What's unusual here is that we've built an entire wealth system on a single asset class. Diversification is supposed to be the first principle of risk management. But at a national level, Australia has done the opposite. We've concentrated wealth, debt, and financial system stability into residential property. And that brings us to the critical question. What happens if this structure is tested? Let me walk through 3 scenarios. Scenario 1, the soft landing. Interest rates stabilize or decline modestly over the next 18 months. Migration remains strong. Supply gradually catches up to demand. Prices flatten but don't fall. Wealth is preserved, but affordability doesn't improve. This is the scenario the Reserve Bank is clearly aiming for. It's possible, but it requires precise policy execution and external stability. China's economy must avoid a hard landing. The US dollar must remain relatively stable. Australia's export revenues must hold. That's a lot of variables that need to align simultaneously. Scenario 2, the correction. A global recession reduces demand for Australian commodities. Unemployment rises. The Reserve Bank is forced to hold rates higher for longer to combat inflation. Property prices fall by 15 to 25% over 2 to 3 years. In this scenario, negative equity becomes widespread among recent buyers. Forced sales increase. Banks tighten lending further. Consumer spending contracts sharply because households feel poorer. Superannuation balances decline. Retirees relying on the wealth effect find their retirement plans disrupted. This would not be a financial system collapse. Australia's banks have stronger capital buffers than they did in 2008. But it would be painful and prolonged. The social impact would be significant. Trust in property as the safe wealth-building strategy would break. Political pressure for intervention would intensify. The government would face difficult choices about bailouts, support packages, and regulatory reforms. Scenario 3, the Japan parallel. Property prices drift sideways or slowly decline for a decade. No crash. But no recovery either. A slow erosion of wealth assumptions. Young Australians continue to be priced out of ownership. Wealth inequality widens as older Australians hold appreciating assets, while younger cohorts rent indefinitely. Social cohesion begins to fray. This is the scenario almost no one talks about. But it may be the most likely. Here's why. Australia's population is aging. The proportion of retirees who own property outright is rising. They have no incentive to sell. Supply remains locked up. Meanwhile, younger buyers face deposit requirements that grow faster than wages. Even with stable prices, the gap doesn't close. It widens. If this continues, Australia risks entrenching a permanent renter class. That's not a housing market problem. That's a social contract problem. When an entire generation is systematically excluded from wealth accumulation through property ownership, The political consequences are unpredictable. We've seen versions of this play out in other developed nations. It rarely ends with calm policy debates. Now let me address the counter-argument. Some analysts argue that Australia's housing market is simply reflecting strong fundamentals. High demand, limited supply, a desirable lifestyle, stable governance. That's partially true, but it ignores the leverage component. Fundamentals don't justify debt-to-income ratios that are double the OECD average. That's speculation layered on top of fundamentals. And speculation is only stable when confidence holds. The moment confidence breaks, whether through an external shock, a policy error, or simply exhaustion among buyers, the dynamics change rapidly. This is the part that concerns me most. We are not just watching a housing market. We are watching a confidence game played at national scale with the largest concentration of household wealth in Australian history. So when you step back, three truths emerge. First, Australia's housing market is not a bubble in the traditional sense. It's a highly leveraged, policy-supported structure that has avoided correction through a combination of sound regulation and extraordinary external demand. The system has worked. But it has worked under favorable conditions that may not persist. Second, the vulnerability is not in the asset itself. It's in the debt underpinning it. Australian households are more sensitive to rate shocks than almost any developed nation. We are sailing close to the wind. One major external shock, a collapse in commodity prices, a geopolitical crisis that disrupts trade, a sharp recession in China, and the entire structure becomes fragile very quickly. Third, this is not just an economic question. It's a generational and social one. If housing remains this expensive, we are engineering a two-tier society. And that has long-term consequences for cohesion, productivity, and political stability. A democracy cannot function well when an entire generation feels locked out of wealth accumulation. History teaches us that repeatedly. Here's the question I want you to consider. Is Australia's housing market a miracle of stability, or a slow-motion crisis we've simply refused to name? Leave your thoughts below. I'm genuinely interested in how you see this playing out. That's it for today. Thank you for watching.